China cuts a key mortgage rate more than expected to try and stimulate its property sector, but the markets aren't impressed. The RBA is keeping a close watch on services inflation, and we look ahead to Australian wages data out today. That's coming up in our 5 Things in 5 minutes. And then in our deep dive interview, ANZ commodities strategist Soni Kumari looks at a looming supply shortage for platinum, just as car makers and the hydrogen economy start using more of it.
Palladium started trading at premium to platinum back in 2017, and the peak of this price ratio was at 3 times of platinum prices, and which gave a very strong reason for auto manufacturers to switch the technology from palladium to platinum.
But first, in 5 and 5 with ANZ, Chinese markets gave a lukewarm response to the People's Bank of China's decision to cut a key interest rate yesterday. The 5-year loan prime rate, or LPR, which is a mortgage reference rate, was cut from 4.2% to 3.95%. That was a record drop, aimed at supporting China's property market and consumer confidence. China's CSI 300 index of stocks initially traded lower on the news, eventually closing up only 0.2%. ANZ senior China strategist Xiao Pengxing says the cut was a catch-up after reductions in the 1-year LPR last year. He says authorities had to balance out yesterday's decision against a larger cut, which would have risked efforts to let air out of the property bubble gently.
What they want to do is to make a structural transformation, structural transition from the commodity housing model to a public housing model, like similar to Singapore. I think this transition or this transformation is not very easy, but the first step is to let the property bubble smaller, so the authority don't want to cut too big.
Number 2. Global markets will watch tonight for comments from 3 Fed speakers and the minutes of the last FOMC meeting. That is the key for the US dollar, which was slightly weaker overnight as US Treasury yields edged lower. The Aussie dollar was therefore up a bit at 65.60 US cents at 5 a.m. Sydney-Melbourne time. And the Kiwi was also a bit firmer at 61.74 US cents. ANZ senior economist Tom Kenny is looking for specifics on what evidence the Fed is looking for to pull the trigger on rate cuts starting in July.
What might be of interest is the Fed and Powell made it clear that they want greater confidence. What is this greater confidence instilled? Are they looking for some kind of threshold level, numerical threshold level on the rate of inflation? Or are they looking for something, more specific in terms of, the trends in supercore inflation? Because that does seem to have been a bit strong lately and probably not eased as much as the Fed would like.
Number 3. The RBA's February meeting minutes maintained a slightly hawkish stance, with the board noting that while goods price inflation was falling faster than expected, services inflation remains high. ANZ senior economist Blair Chapman says the RBA will want to make sure inflation doesn't pop back up like it has overseas.
The RBA and other central banks, knowing that services inflation is more closely linked with the domestic economy, very much focused on making sure demand and supply are balanced within Australia so that services inflation comes down. Although historically we have seen services inflation sitting above goods inflation and the inflation overall being in the target band.
Number 4. Today's Australian Wage Price Index will be a key data point for the RBA as it considers its next interest rate move. ANZ senior economist Catherine Birch says the expected quarterly increase of 0.9% would mean an annual rate of 4.1%, and that's in line with what the RBA expects.
The RBA has repeatedly noted that it assesses the current pace of wage growth, or potentially a little higher, as being consistent with its inflation target, as long as productivity picks up to its long-run average. Now, we'll get more productivity growth data in the National Accounts data, which will be out on the 6th of March. But that suggests that they won't be too worried if, say, wage growth is 0.1 percentage points either way of their 4.1% annual forecast.
Number 5. Now, in New Zealand, ANZ's merchant card spending data shows most categories improved in the 3 months to January, up 3.5% annually, and that's a bit stronger than the 2.5% seen previously. ANZ New Zealand Chief Economist Sharon Zollner says strong tourism-related spending, up 38%, and a range of discretionary spending, particularly on golf courses, up 20%, show there are some green shoots.
Fair to say they're tentative at the moment. The housing market remains pretty flat, for example, so that's not likely to set consumers on a path towards spending freely anytime soon. But certainly the Reserve Bank requires very subdued spending for quite some time. That is their forecast. So anything that suggests that perhaps the economy might be bouncing back more quickly than expected, they would probably view as problematic.
Sharon Zollner there. Now, in our deep dive interview, ANZ commodity strategist Soni Kumari details the structural shifts in supply and demand for platinum and sees the potential for price rises.
There are a few reasons to it. First, the auto sales have been quite strong since the second half of 2023. And for this year, we are expecting auto sales to grow by 2 to 3% range. And that is keeping, the platinum auto catalyst demand strong. The other reasons, which is a very, very relevant reason for platinum demand story, is substitution away from palladium to platinum. And there are two reasons for it. The first, it's related to economics of the auto catalyst. Palladium started trading at premium to platinum back in 2017, and the peak of this price ratio was at 3 times of platinum prices, and which gave a very strong reason for auto manufacturers to switch the technology from palladium to platinum. The other reason, which is related, is the supply security. Since Russia produces nearly 38% of palladium, this makes the auto catalyst vulnerable to sanctions. So far, there's no sanction on Russian palladium, but we don't know the future. So therefore, we expect switching from palladium to platinum to continue.
And on the supply side for platinum, what are some of the problems that platinum miners in South Africa have? Because 70% of the supply comes from South Africa.
Well, like any other mining country, South Africa is also seeing some of the challenges in form of deeper shaft, degrading ore quality, environmental regulations, social protest, etc. But apart from that, what has been really constrained the production was electricity outages in 2022, and it had costed a heavy production loss back in 2022. So this year, electricity supply availability is likely to improve, and that's why we are expecting production to recover as well by 3%. However, the production level will still remain nearly 7% below pre-pandemic average level.
And how is the growing hydrogen economy increasing demand for platinum?
Platinum is used as a catalyst in hydrogen economy, and the drive towards this hydrogen fuel is definitely going to benefit platinum demand. But this is a long-term story for platinum. So what can benefit this platinum demand in the long term is we are seeing auto catalyst demand for platinum to decline because of declining share of ICE vehicle, and that demand losses could be mitigated by rising demand from hydrogen economy. So there, it's a far-fetched demand outlook, but definitely platinum demand is going to benefit from this energy transition.
And just finally, what do you see then for the platinum price through 2024?
As we expect platinum market balance to remain negative due to constrained supply and a strong demand, we target platinum prices to reach towards 1,200 by end of this year to just incentivize supply and curb some of the demand.
Soni Kumari there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, February the 21st. Catch you tomorrow with the detail from Australian wages data later today. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.